Mentioned those oil prices are also slipping as fears grip the market. And in fact, oil prices are back now to where they were when OPEC announced that they would be cutting production by 2 million barrels. Obviously, concerns about global growth and a looming recession taking the baton here in terms of the direction for prices. Let's bring in Michael Tran. He's Managing Director of Global Energy Strategy at RBC Capital. Michael, thank you so much for being with us. You've gone ahead and you've done some work, because everybody is so recession obsessed, about where exactly could energy prices go in different recession scenarios. And of course, the headline grabbing one is where it could go in a deep recession, $60 for Brent. Walk us through that scenario, but also what kind of probability you assign to it.
Yeah, it's great to be with you again, Amber. I think what's really interesting is the name of this game right now is volatility. I started last week on this show, and we're pricing about $84 a barrel last Monday. We ripped up $10, $11, and we've given almost all of it back just in the past few days. So I think the volatility will really continue here. We're taking a bit more of a cautious tone than we usually have in terms of the pricing. What I think is really important to highlight, though, is we're concerned about the recessionary fears. Everybody knows why that's taking place. We're still very structurally constructive, structurally bullish, the medium term post-recession. Now, what I think is really key here is when you think about the Fed, interest rates, the inflationary environment, there's a lot of different policy level cross currents that need to take place right now. And as a function of that, when there's a lot of fear in this market, oftentimes it's a sell first, ask questions later type scenario. Now, our general case here is prices are going to just chop around this $80 level for much of the next several quarters. If you do get a deep recession, we think that prices could potentially go down to the low 60s. We only assign a 15% probability to that. But instead of really fear-mongering here, what I really want to highlight really quickly, Amber, is this idea that when you historically go back and look at recessions, you don't actually lose that much demand. In 2008, a deep, protracted recession, what we did was we lost only about 2.2% of global oil demand. Demand contracted for 5 quarters. So this is what we're really bracing for right now, is potential downside threats, but we're really still bullish the medium-term outlook.
Yeah, and it seems like your base case highlights, that oil could just hang around these current levels because of the tension that I kind of alluded to in the beginning, which is supply constraints, which act as an upward force, but concerns about a recession. But to your point, if you look at history, that doesn't actually weigh on the demand side of things. It's interesting, though, that still affects the overall price.
Yeah, look, Amber, I think what's really fascinating right now is we've entered an oil market that's very different than the oil market that we saw in the first half of the year. First half of the year was very much a fundamentally driven market, supply, demand, crack spreads. We understood all the different components. What's really interesting that's played out since Q3 is this has really become a policy-driven market, whether, again, it's the Fed, whether it's OPEC going from a loosening cycle to a tightening cycle, whether it's Biden SPR, whether it's China and their zero COVID policy, and on and on and on. I can't forget, price caps on Russia, perhaps. There's just so many different layers of policy out there right now that make this market really tricky. And as a result of that, the reason why we think oil prices just kind of chop around this $80 level is largely because there is a degree of policy paralysis in this market. People just don't know what to do because there's so many levels of policy, and some of them kind of contradict each other in terms of what that means for prices. Policy paralysis leads to positioning paralysis. Yeah, policy paralysis really leads to positioning paralysis in the oil market, and this is why liquidity in WTI is down about 42% on average since the summer. So when there's no liquidity, that leads to a lot of volatility.
And I wonder if the type of investor also matters here, because for years, we talked about this here on BNN, the number of energy-focused portfolio managers in this country, I think, is now down to 2, even with the resurgence in oil prices. You've had a lot of people for a number of years who didn't really have to pay attention to this sector. All of a sudden they do, because that's kind of the only area of outperformance. What does that do to volatility?
Right. So look, Canadian investors, certainly the two that you mentioned, very good friends of ours. When we think about this framework, and I think what's really fascinating about, let's call it generalist investors, so that those that invest across the equity spectrum. What's really fascinating is over the course of the past 5 years, naturally, anytime oil prices pulled back, they were the first ones out the door. Right, and naturally, because there's other sectors that you can invest in that outperformed. What's been really interesting now is in my conversations with clients over the course of the past several months, is everybody understands why oil prices could potentially go down. It's a macro issue. And the comment is, well, $80, $70, these are still very good prices for E&Ps, particularly those Canadian ones that benefit from, a weaker Canadian dollar. So as a function of that, a lot of people say to me, given the cash flow generation for these companies, where else would you rather be than energy right now, even if we are going into a downturn, just given the outperformance?
What about the relationship between oil and the U.S. dollar? We always talk about rising U.S. dollar being a lid on commodity prices. What is the relationship that you've observed between oil and the U.S. dollar, and whether there's been kind of a breakdown there?
I love this question, Amber, because it's just so important, because anytime you see the dollar moving higher, or the dollar index moving to unprecedented or near unprecedented levels, or at least multi-year, multi-high levels. What's on the backdrop of that is correlations for risk assets generally go to one, right? I mean, you see things like energy, you see things like equities, you see things like crypto all move lower off the back of that because there's this rush to safe haven assets. Now, what I think is really interesting here is some of these historical regressions or models are kind of misleading in terms of how you think about this space. Because if I'm at a hedge fund and I manage a macro portfolio, and I'm certain that I'm concerned about the world, I want to get into the dollar, and you basically look at screening tools or algorithms to say, find me something that I should short as a relative value trade, it's effectively energy, because you have a negative correlation of about 0.8 between the dollar index and oil. The issue here is, again, this idea that the dollar index has gone to extreme multi-year highs, and that suggests that they should be pressing the sell button really, really hard on the oil side. Whereas when we think about things, the oil market fundamentals are still really strong, and we do believe that over the course of the medium term, prices will be materially higher. We know that. The algorithms don't necessarily know that during times of panic.